So let's bring another voice into this, because 2 years after he first flagged inflation's big generational comeback, market forecaster Jim Bianco sees price relief ahead. But he warns that Wall Street may still see a world of hurt, a world of pain next year. So Jim joins us now. He runs Bianco Research. He's a guy that a lot of folks see and listen to on Wall Street. Jim, thanks very much for taking the time to join us here on Fast Money. So I wonder, maybe I'll just open-end question to you to start. This inflation narrative, is it over?
It depends on what you mean by over. Has inflation peaked? Yes, it's probably peaked at 9.1% in the spring, and it's coming down. Now, I know that's enough. Everybody's going to run and say that's it, bye. But the real question is not is it coming down, is how far down is it going to go? And I'm afraid that it might bottom out at around 4%. And the Fed has already said that they think neutral on interest rates is about 0.5% above the inflation rate. If it does, that means we've only just got back to neutral. And Jay Powell said that he wants to eventually get to restrictive. Now, if it goes all the way to 2%, then we are restrictive and there can be some kind of a pivot. So, yes, it's peaked, but that's not the real question. The real question is how much further down does it have to go?
So Jim, with that in mind, then, if it's a matter of how high it stays relative to where it was, right, a year, 2, 3, 4 years ago, if it remains elevated at those levels, is there a way out? What needs to happen elsewhere in the economy to offset the effect of inflation staying at relatively high levels that we've seen over the course of the last, say, 5 years?
Well, what we're arguing here is that inflation, there's been some kind of a secular shift, that the era of 2% inflation is over. And I've termed it the era of cheap labor, cheap goods, and cheap energy is behind us. So we're going to have to restructure the economy in some way in order to return to, cheap labor, cheap goods, and cheap energy again. Restructuring the economy is more of a value cyclical kind of play, but it requires a lot of money and it requires a lot of time to do it. You don't restructure the economy in a short period of time. Look at the supply chain. We've been talking about the supply chain being fixed, and we're nearly 3 years after the pandemic hit, and it's still not all the way back. And that came back at lightning speed. So to restructure the economy is going to take even longer.
Jim, this is Courtney here, and just had a question for you where it does sound like you see inflation coming down, which I think is a great sign, but you also noted that you see PPI coming in hotter than expected tomorrow. And I'm curious why you see that and kind of what you see the market reaction to that.
The market right now is fixated on gas prices. That's what it seems to be focused on in terms of how it forecasts PPI and CPI, and gas prices have come down. And the other thing to keep in mind, too, of the last 20 months in inflation numbers, only 4 of them has been below expectation. So even if you just did no analysis and just said it's going to be above expectations, you've been right 75% of the time for the last 2 years. So there is this structural bias in the market to look at the data and then shade it lower and hope lower, and then you add in falling gas prices. And that's why I think that there might be an upside beat for tomorrow. But, that's one number, and that's one guess on one number.
All right. Jim Bianco, thank you very much for the thoughts there for the guy that originally kind of really called the kickoff to this inflation narrative. We appreciate it. We'll see you soon, Jim.
Thank you.
All right, guys, let's trade this here. If we take a look at this guy, Jim made a point that he thinks that the inflation read for tomorrow, business level inflation, comes in slightly hotter than expected. That eventually does kind of flow through to consumer prices. But how worried should we be?
Well, if it comes in hotter than expected, given what we traded up to, we traded right to the downtrend line that we put in November of last year, right up to the 200-day moving average, about a 14.5% rally from October 14th into that level. A hotter number is going to take us right back down to 3,800 probably. So if that's the only lens you want to look through, you should be worried if it comes in hotter. I think it may, but I could be wrong. Tim thinks it's going to be softer. We'll see. I'll say this, though, to Jim's point. We might get to 4%. I don't see that in the near future. It ain't going to get down to 2% for quite some time, and that's their mandate, and it ain't going to happen.
What do you think, Dan?
Listen, we're going to obsess over every one of these numbers, and the first Friday of every month, we're going to have this jobs number. We're going to pray for it to actually go up. Isn't that kind of absurd in a way, right? Because that's the thing that might relieve the market and might kind of cause the Fed to take their foot off the pedal. I'll just say this. If you were dying, everybody wanted oil to go lower. It just closed at a 52-week low today on a day where there was, positive rumblings out of China about what they're doing with zero COVID. And that was the thing that's going to kind of reignite the global economy at a time where Europe is in a recessionary environment. Our economy, it looks like we're kind of sputtering a little bit. It just doesn't feel like the sort of indicators that you'd be hoping for or the reaction to the news that you might expect is happening. And so, again, I'll just say this, is like the stock market down 17% or whatever the S&P is down right now, it just doesn't encapsulate what we've been through. Go back to kind of 2008, there was 1 year where the stock market was down in the middle of the throes of this financial crisis. It was down nearly 40% or so. And you're just telling me of all the fiscal and monetary we've thrown into this, all these bizarre issues with supply chains and the geopolitical stuff and the macro stuff. It's just like, that's it. That's not it, people. I mean, like, so whatever we do between here and the end of this year, there's a reckoning coming at some point next year. I don't mean a crash or anything like that, but there is not enough fear in this market. I think one of you guys said this, the VIX at 22 right here, given everything we know.
I hate the VIX at 20.
Yeah, you know what I mean? Like,
I actually think if we didn't have the VIX at 20, if the VIX was at 28 or 29, I think you really had room for a rally. And again, remember where we were on the VIX. I keep bringing up this October 13th CPI because it was such an extraordinary day. We had a really, really hot CPI number. It looked like this was the time for the market to cave through the bottom. And in fact, that was essentially the time when we actually priced in maybe peak inflation. And as Jim talked about, maybe that's where we are. But I just think there are opportunities in this market, and that's really where we are. We're going to have these ranges. And I agree with these guys. It's really tough to see where we can get much higher. But I just believe that the core inputs here, if you look at where the pressure on the Fed, it's certainly lightening up. And I think, look, we have a little bit of a window. Of course, we have the Fed next week. We have CPI on Tuesday, which is a much more important number. I think we have to get through those events, and then I think we have some room.